All right, today we're going to take a look at lump sum investing in Bitcoin. So ultimately, there's two strategies when combined, I think are, in my opinion, is most effective. One of them is dollar cost averaging, pretty common approach in traditional investing. You choose a dollar amount, you equally space those investments over a defined period of time. For example, you could dollar cost average daily, monthly, weekly, etc., right? What I like to do is just say, hey, this is the amount of money I want to invest over 365 days, right? Take the grand total, divide it by 365, and then invest daily. That way you're going to catch if you do it weekly or if you do it monthly, it could be up one month, down another month. It's kind of spaces it out. It makes it a lot smoother the more frequent you do it. I mean, there's some, River is a great platform, one that I like to use. You can do it hourly. I think that's aggressive. I don't think that's a nightmare when it comes to tracking all those trades and your cost basis, etc. So what I recommend is the tightest one would probably be daily. You can do weekly, whatever you want, right? Set that. That's your thing. You set it once, you forget it, and you invest that money, right? The next question comes, great, Pat, what are the other options? And the other one is you come across some money. You get a bonus at work. You get a gift of money. You sell another asset and you want to redeploy it into Bitcoin, right? You could just increase your dollar cost average and build it in. That's one approach, but I think it's nice to have a base of just consistent investing in Bitcoin, and then on top of it, lump sum, right? So I usually don't do this all at once, but what I'll do is I'll say, hey, there's X amount of money I have. I'm going to put 2% or 10% or whatever it is into this and gradually place several orders at certain, buying the dips, right? At the end of the day, one other way to think about this is you always hear people buy the dip. Well, let's figure out a strategy that can best do that. And I've tried a bunch of different ways. I would take a look at technical analysis and where support levels are. Those are great. Another one is daily moving averages. But one I've recently really dug into and I think is worth exploring, and again, none of this is financial advice, this is just educational, is Bollinger Bands. Okay, and what it does is it really takes a look at a few different variables. You do a simple moving average, right? And you've got a lower band, a middle band, and an upper band. And then you do two standard deviations is the most common one, right? If you go to TradingView, I'm going to pull it up. It's already in there. You don't have to do anything. Just click into it, and you're good to go, right? I'll actually show you how to do it. So what I then did is I went to Grok. I went to AI and I said, hey, let's back test this for over a 4-year period, a 10-year period, etc. Let's identify what the best number of days to set as your threshold for your moving averages. So we're going to go ahead and jump in and take a look, okay? So what we have here is an image of Bollinger Bands. So you've got the lower, right, level here. You've got the upper level, and you've got this mid-tier. Now, this mid-tier I set at 15 days, and I'm going to explain why, okay? But here's the cool part, is it creates this more flexible range, and it kind of tells you where it believe the price should land between, okay? And so what I'm going to do, I'm going to go to TradingView. I'm actually going to, here, let's do this. I'm going to go to indicators. I like this, just do where did it go? Bollinger Bands, okay? So I create another one. It defaults to the 20-day, and you can see that overlay here. I'm going to delete this. It's as simple as that. It's literally as simple as that. And then you can go in here and you can change to 50-day. You can change to 100-day, and watch. It just changed the outlook, right? So I'm going to delete these real quick, and I'm going to show you what some of the typical ones are, right? So ultimately, the goal is to buy the dips, but not miss too many of the dips, okay? So if we remove this, And you can see this is on the 1 week time scale, which I think is good for this purpose. Now, what we're going to do is I'm going to put in the indicator again, okay? And you can see common ones are 20, 50, 100, 200 day moving averages, okay? So I'm going to go to Bollinger Band. It defaults to the 20. I'm actually going to bump this out. We're going to get crazy with it. Let's start at 200. Let's see how many dips we get. So this right here is the 200 day, and then you can see the standard deviation below and above. Here's the thing. If we go all the way back, we would have sat around and not made any purchases for the last 2 years. Okay, we go all the way back to October of 23, and you can see great times to buy, obviously, right? But the problem is, I don't know about you, but when is Bitcoin going to be back at 53,000? I don't know. Will it ever? I don't know. Here's the thing, though. If we're looking at this, we would have literally sat around for 2 years, and it doesn't look like we'd be buying anytime soon. That's too long, right? So let's just play around with this. I'm going to show a few examples, okay? Let's go 100. Raises the bar up, but you can see here, same situation, right? Last time we would have purchased was 2 years ago. I don't like that. We're not catching it up. Of course, these are amazing buys right here. I mean, FTX, we're at 16, 17,000, right? Those are all really good buys, but the problem is we're going to sit around, and if you even go all the way back, the last purchase would have been March, the pandemic, March of 2020, and then we would have sat around for 2 years, okay, before we would have started buying again, and we would have had a good spree, right? May have 2022 all the way to October of 23. That's a good run, but then literally just sit around. And you can see we would have had very few times. You buy these bottom dips for sure, but it's just we're giving up too much opportunity there, right? I don't want to sit around for years trying to make an investment. Let's go to 50, okay? And here's where we're at with 50. You can see we're catching some, but these are wicks, right? Like if we really dig into this, these are just wicks down. We don't even have solid candles. Okay, that was just a wick down. You caught it right there in April. Sit around, and we're not anywhere near there. The previous order would have been this wick in September of 24, another wick here. And really, I mean, look at how far back we got to go. We got to go all the way back again to March of 23 again, right? So this is, again, too inconsistent, right? So 50-day moving average. If we get to a 50-day moving average, do it, right? Place smash orders, smash buy. It's great. So let's go 20, okay? And this is where we're going to start to dig into the numbers. So then I ran it as 20 because that's another common one. And I see here, okay, catch, cool. We're placing some more consistent orders. I like this, okay? And when there is a time where there's a more dramatic dip, I mean, you can be placing orders for, what is this? You could have been placing orders from February to April, February, March, April, for 3 months. That's great. And then here's another buying opportunity. And then we go all the way back. So you kind of get the gist, right? So what I did is I said, well, what is the ideal range, right? And I don't know, I'll just use the resources at our disposal, right? And so I plug it into Grok and I asked the question, right? And it took a look at the 15-day Bollinger Bands right here. You can see that, right? Now, what it also did is it looked at some other resources. So then it looked at the 14-day simple moving average. So not the Bollinger Band, they're very similar, but a little different. Here's the thing. It ran 15, 20, 14, 21, 10, 7, 10, 28, 50, 100, 200, right? Here's the thing. You were not buying enough. This is, again, an amazing return, right? 1,500. What was the time span I did for this? I don't remember. I think it was past 4 or 5 years. Doesn't matter. You'll get the gist from the numbers. All right, so 1,500, 1,700, 1,950, getting a little better, 2,300. This is interesting. The 10-day, the 7-day, and we work our way up, okay? 20-day is the default. By most people, most traders, most even just the pre-built solutions within TradingView, for example, default to 20-day. It's a great resource. But I started to play around with it manually, and I got this 15. And look at this 15-day Bollinger Band. Look at this. 3,200. Okay? That's pretty awesome. Okay? Really good results there, right? And so then I said, okay, so that's ideal, right? So then we scrolled down, and then I said, okay, let's try and figure out, is there anything between 7 to 20, okay? Just to make it even tighter, all right? Because we already knew 50 was too long, 20 was a little bit better. There's a 15, but I want to know if there's anything from 7 days, a week, which is very quick, all the way to 20. And it did every single 7, 8, 9, 10, 11, right? All within the Bollinger Band. And what you can see here, too tight, win rate 58%, 105 trades, that's a lot of trades, right? Max drawdown, sharp ratio, etc., right? So when we roll down and we look, this is getting better and better and better. Now here's where the law of diminishing returns happens. At 15-day Bollinger Band, 32.15. You can see a drop off after that, right? Because we're getting more conservative with those buys. And you can see we had not as good as a win rate. I mean, if you literally just say, I'm only going to buy at the 200-day moving average, your win rate's going to be through the roof because it's rare that Bitcoin lives below the 200-day moving average for a long period of time, right? But I don't want to place orders that infrequent. So this is what we're looking at. 58 orders, max drawdown 15%, and then 1.7. Now, of course, there is much larger drawdowns in that entire time frame, but this is taking into consideration over a time span, etc., right? So 70% win rate and the best return. We're not giving that much up. Look at 71, 71, 72, 73, 73. But by ensuring we're not investing too early, right? Because sometimes these dips can go lower and all that kind of stuff. Or there's a breakout or a false number, whatever it is. I'm willing to give up that 3% to have substantially higher returns, right? So ultimately, based on what Grok has shared and doing back testing, we're looking at 15-day Bollinger Band as the optimal way to do your buy orders. So what I do is I go in, I'm going to change this from the 20, and you're going to see that it's going to get a little different. I'm going to set it at 15, okay? And we're going to say, okay, cool, great. Now, if you want to be more aggressive, let's go straight off of the 15-day moving average here, okay? And you can see we're more consistent with the buys. You get these nice dips, and you've got these consolidation periods where you are just buying, which is great. And you can see here there's a lot more consistency. The other cool thing is take a look at this. It's actually an interesting indicator for where we are in the bull cycle. So you can see here, this is a consolidation phase, lots of orders being placed, and we're going back to the previous 4-year cycle, and right around October, okay, October 20, we're in October, you guys have seen the numbers run up, you're not placing that many orders, okay, which is fine, because then we get into these time periods of these dramatic drawdowns, and you're getting aggressive, you're getting after it, because I mean, some people might say, well, if I would have bought here at this number, it would be better. Yeah, you're right. But we don't know. We just simply don't know how Bitcoin's going to perform. So this is just a little safer way to do it. And you get in here and you're buying these nice dips, right? Now, where it crosses over is, now they say don't try and catch a falling candle, but if we believe Bitcoin's floor is right around the previous all-time high, then we can see that we're likely around the floor around 69K. There you go. We're in a good spot. So anyway, what I'm saying here is you can see in this bull cycle, okay, which started, this is after the FTX when we really took off, was January of 23, and then you can see we had this upward trajectory. You have some nice buying opportunities along the way in these consolidation periods. Then it's going to run up. Okay, we're going to wait, and then we're going to have this opportunity, this nice buying opportunity, right? Consolidation. We've got another run up. We're waiting. Then we're going to buy in this. This is almost a pullback. I wouldn't even call this consolidation. This is simply a pullback. And you can see here we have some really good opportunities. Right now, we are popping above the upper Bollinger Band. Going to wait, right? So what you can do is you simply see here, place a limit order. And again, the best way to do these is to set limit orders. So you go ahead and set a limit order at 114.893. You can see the number on the side here. You can see it over here. and you can place that order. Now, if you really wanted to get aggressive, you can also put your lower band at the 106. And why not stack some limit orders between the 114 to the 106? Not a bad way to do it, right? You just stack a bunch of limit orders between these two bands, and as this rises, maybe you check it once a week or every other week, maybe once a month, whatever frequency you want, and you can just update these. So if we're running up, go ahead and there's scripts and stuff you can do, but the simple way is just manually update these. You can just change these limit orders. So if we're continuing to go up, well, maybe you want to catch those pullbacks, but you don't want to be stuck here in case we run up too high, right? So you can just move them up, or if we're on a downward trend, maybe move them down. But placing them between the blue and the green, probably a good play. So there you go. I wanted to share some ideas with you guys. This is one I've been playing around with, leveraged AI to really get some ideas on what the optimal days are for these moving averages. And as you saw, 15 is kind of a sweet spot. This is an approach I'm going to kind of pivot over to, because I was previously either going off of gut feelings, which isn't the best, or just simply operating off of technical analysis, resistance levels, those kind of things. You can combine those, or you can just follow this method. Is something to experiment with. Again, not financial advice, but here to help you guys share some insights and what I found quite eye-opening when we did some back testing through leveraging Grok. So there you go. Like and subscribe below. Keep stacking those sats. Stay sovereign. Thank you.